For most of human history, money was not an idea. It was a thing you could hold. A coin, a bar, a weight of metal pulled from the earth that everyone, kings, farmers, merchants, thieves, agreed was worth something. Before that agreement, there was only barter. A farmer with grain, a blacksmith with tools, a fisherman with nothing to trade but fish that would rot by morning. Barter worked sometimes, but it was slow. It was fragile. It required two people to want exactly what the other one had at exactly the same time. So humans invented something better. A middleman that never spoiled, never argued, and never lied. Gold. It didn't rust. It didn't decay. It could be melted, measured, and divided. And it was rare enough that no one could simply make more of it by wishing. For thousands of years, this was enough. Gold was money, and money was gold. Whether you were in Rome, in Byzantium, or in a market town in medieval Europe, the rules were roughly the same. Trust wasn't given to a government. It was given to a metal. But as empires grew and trade crossed oceans, carrying literal gold became a problem. It was heavy. It was dangerous to move. So a new idea emerged, one that would quietly change everything. The paper promise. Banks began issuing notes that represented gold, safely stored in a vault somewhere far away. The paper itself was worthless, but it stood for something real. A promise, backed by metal. This system had a name, the gold standard. And for a while, it created something the world had rarely seen. Real, structural trust between nations. If you were in London, and I was in Paris, our currencies weren't just numbers on a page. They were both, ultimately, claims on the same thing. Gold. It made trade predictable. It made prices stable. It made empires feel permanent. Then came the 20th century, and 2 world wars that shattered the illusion. Nations printed money to pay for war they couldn't otherwise afford. Gold reserves were drained, hidden, fought over. By the end of the Second World War, the old system was in ruins, and something had to replace it. In July 1944, 730 delegates from 44 Allied nations gathered in a hotel in a small New Hampshire town called Bretton Woods. Their task was enormous: rebuild the global financial system from the ashes. What they built was ingenious and fragile in ways nobody fully understood yet. The US dollar would be pegged to gold at $35 an ounce. Every other major currency would be pegged not to gold directly, but to the dollar. The world, in effect, agreed to trust one nation's promise, because that nation held the largest gold reserve on Earth. It was called Bretton Woods, and for nearly 3 decades, it held the global economy together. Tourists exchanged currencies at fixed, predictable rates. Central banks knew exactly what their money was worth, today and tomorrow. Businesses could plan years ahead without fearing a currency collapse overnight. It felt permanent. It felt like the natural order of things. But underneath the calm, a quiet pressure was building. The United States was spending more than it could back in gold, funding a war in Vietnam, funding social programs, funding its role as the world's reserve currency. Other nations began to notice, and some of them began to ask an uncomfortable question. If we hold dollars, can we actually trade them for gold, like we were promised? By the late 1960s, that question was no longer theoretical. Nations were lining up quietly to test America's promise. And in a vault in Fort Knox, Kentucky, The answer was becoming impossible to hide. The gold was not enough. Something was about to break. And when it did, the entire idea of what money even was would change forever. The day money lost its anchor. On August 15th, 1971, the promise finally broke. There was no vault being emptied on television, no army marching through a capital, no dramatic announcement that the world's financial system had collapsed. Instead, the announcement came from a president speaking to the American people on a Sunday evening, Richard Nixon. And buried inside his speech was a decision that would change the financial world forever.
We must protect the position of the American dollar as a pillar of monetary stability around the world.
The United States would temporarily suspend the convertibility of the dollar into gold. Temporarily. That was the word used at the time. But temporary would become permanent. For nearly 3 decades, the dollar had been connected to gold at $35 an ounce. Now that connection was gone. The dollar was no longer a promise that could be exchanged for a fixed quantity of metal. It was something different, something the modern world had never really experienced at this scale. Fiat money. Money whose value was no longer tied directly to gold, but to the confidence people placed in governments, central banks, economies, and the system itself. And once that anchor disappeared, something else had to take its place. The world needed a new way to determine what one currency was worth against another. And that price could no longer simply be declared. It had to move. The United States, Europe, Japan, Britain. Each economy had its own interest rates, its own inflation, its own political problems, its own strengths and weaknesses. And suddenly, those differences mattered. A lot. Because if one country's economy became stronger, demand for its currency could rise. If inflation increased, its currency could weaken. If interest rates changed, money could move across borders in search of better returns. Currency was no longer just something you used to buy foreign goods. Currency itself had become something that could be priced and traded. The foreign exchange market was beginning to take the shape we recognize today. But there was a problem. How do you create a global market for something that exists in dozens of different forms, belongs to different nations, and never physically sits in one place? The answer was banks. Big banks. They became the bridges between currencies. A company in Germany might need dollars to pay an American supplier. A Japanese corporation might need euros. An American investor might want to buy British assets. And behind every one of those transactions was a currency exchange. But the banks didn't simply process these transactions. They began trading currencies themselves. They bought when they believed a currency was cheap. They sold when they believed it was expensive. And because banks were connected to one another across continents, a new financial network began to emerge. London, New York, Tokyo, Frankfurt, Hong Kong, Singapore. The market was becoming global, and unlike a stock exchange, there was no single building where everyone had to meet. There was no opening bell, no closing bell, no central trading floor. The market simply moved from one financial center to the next as the earth turned. When London went to sleep, New York was still trading. When New York closed, Tokyo was waking up. And when Tokyo slowed down, London was preparing to begin again. Money never slept. The market never truly closed. But something even more important was happening. Currencies were starting to float. Their prices could rise and fall according to supply and demand. And that created a completely new kind of financial opportunity. For the first time, traders didn't necessarily need to own a company. They didn't need to build a factory. They didn't need to produce oil, wheat, or gold. They could simply make a bet on one currency becoming stronger or weaker against another. Buy one, sell another, and profit from the difference. It sounds simple, but behind that simplicity was one of the most complicated markets ever created. Because currencies don't move for just one reason. They move because millions of people are making decisions at the same time. A central bank changes interest rates. An inflation report comes out. A government falls. An election surprises investors. A war begins. Oil prices collapse. A country's economy grows faster than expected. A central bank says 3 words the market wasn't expecting. And suddenly, billions of dollars move. Not because the physical money has been transported across a border, but because expectations have changed. This was the beginning of modern foreign exchange. But the market was still largely closed to ordinary people. For decades, foreign exchange belonged to institutions, central banks, multinational corporations, investment funds, and the world's largest commercial banks. The average person had almost no way to participate. If you wanted to exchange currencies, you went to a bank. You handed over your money. They gave you another currency. And that was it. You weren't sitting in front of a chart watching the Japanese yen move against the dollar. You weren't placing an order from your bedroom. You weren't watching prices change every second. That world didn't exist yet. Then technology arrived. Computers began replacing telephone calls. Electronic networks began connecting financial institutions. Prices could move across continents almost instantly. And gradually, the foreign exchange market transformed from a network of phone calls between powerful institutions into something much faster, much larger, and eventually, much more accessible. By the 1990s, the internet was beginning to change finance itself. Information that once took hours could now travel in seconds. Trading systems became electronic. Charts appeared on computer screens. Prices updated in real time. And suddenly, a question that would have sounded ridiculous only a generation earlier became possible. What if ordinary people could trade currencies too? The banks had built the market. Technology was about to open the door. But opening that door would create an entirely new industry. An industry that promised ordinary people access to the same market once reserved for financial institutions. An industry built around one seductive idea: that you didn't need billions of dollars to participate. You only needed a computer, an internet connection, and a small amount of capital. It was the beginning of retail Forex. And for millions of people around the world, it would look like the opportunity of a lifetime. But there was something the advertisements didn't always tell them. Because the same system that could amplify a trader's profits could amplify their losses just as quickly. And behind that promise of easy access was another invention. One that would change the game completely: leverage. And when leverage entered the hands of ordinary traders, Forex stopped being just a market. It became a machine capable of turning small decisions into enormous consequences. And the next revolution was already waiting. And that is how we arrived at Forex. Not through one invention, not through one bank, and not through one moment in history. Forex was built slowly over centuries, from coins to gold, from gold to paper promises, from Bretton Woods to the moment the dollar was finally cut loose from gold. Once that happened, currencies began to move freely. And when currencies began to move, a market was born around those movements. Today, every time the dollar rises against the euro, every time the yen falls against the dollar, every time a central bank changes interest rates, the consequences can ripple across the entire planet. Because Forex is not simply about buying and selling currencies. It is a reflection of the global economy itself. It reflects confidence, fear, inflation, interest rates, war, trade, politics, and millions of decisions made by people and institutions around the world. The market that once belonged almost entirely to governments and giant banks can now be accessed from a laptop or a phone. But that accessibility can be deceptive. Behind every chart is a global economic system. Behind every price movement is a reason. And behind every potential profit, there is risk. Forex didn't begin as a way to make ordinary people rich. It began because the world needed a way to exchange one form of money for another. But over time, that necessity became an enormous financial market. A market moving billions of dollars across borders. A market operating across time zones. A market that never truly sleeps. And perhaps the most fascinating part is this. The money itself may have changed. Gold became paper. Paper became numbers. Numbers became digital. But the fundamental question has remained the same for thousands of years. What is money worth? And who decides? Today, that answer is no longer buried inside a vault of gold. It is moving, every second, in the world's largest financial market, Forex.